welcome to my channel. So this video will be about how to calculate basis for rental real estate property. Let's dive in. When we buy the building, we use it to produce the income. The building itself is losing its value over time. We're hoping because of the location of the building, not necessarily the building value, the investment will go up in time. Depreciation is recovery of the cost of income-producing property. It means our investments through the yearly tax deduction. By depreciating the property, we are deducting some of the cost each year on the tax return. So there is three factors to determine how much depreciation you can take that year. First one is basis for depreciable property. Second one is the period of recovery. And third one is which methods you decide to use for depreciation. So by taking depreciation, we reduce the basis for your property. So eventually, when you sell the property, the basis that you will take against the gain on a sale of property will be lower because of depreciation. But I'll go over it in more details. So the land can be depreciated because usually the land doesn't lose its value. It doesn't wear out as building does. But improvements for land, like a landscape, can be depreciated as improvements. Alrighty, let's switch to the next part. Thank you for watching my video. Just a quick interruption. I'm sorry. Just to tell you that I do sell online courses. So if you go to my website, remotecpanla.com, it will give you more information about online courses that I sell and what I teach, and with more information about me, agenda on what we do. We have a weekly calls. We go over the different kind of issues or problems we can have in the tax software. So in the end of this 1 month course, you'll be able to prepare like a complex tax return in any tax software you choose. Thank you again. Please continue watching my video. Alright guys, so next part of this video will be about basis for depreciation when we buy rental real estate. So here on the screen you can see the IRS publication. It's about rental property and all the rules applied for rental property. So this part is about basis for depreciable property, and it goes over examples, what is cost is, what it includes, what it doesn't. So basically adjusted cost of the property you're purchasing is the cost you purchase it from and also additional costs associated with it. It called the settlement fees and other costs. So like it says here, it can be any of those like legal fees, transfer taxes, title insurance, surveys, things like that. So here it doesn't include real estate taxes. So usually when your client is purchasing a property and it tells you that it will assume somebody else's responsibility over real estate taxes when the property was not owned by them, it means they cannot deduct that real estate property, so they can add them to, there's a property here, so they can add them to the basis as well. If they pay for real estate taxes for a period after the date they own the property, then they expense it under itemized deduction or deduct it under real estate expenses. But if they pay for real estate taxes for a period before they own the property, they can add it to the cost as well. So that's important thing. And here we have lots of settlement fees as well. So let me show you example of settlement agreement. It's right here. So here, like sale price of the property. So this would be our cost. And also here's our real estate taxes that I just mentioned. So this was dated actually July 15. The property purchased on July 15, 2022. So they paid for real estate property after they owned own the property. So it means they cannot include this in the costs, they can expense those. But if here we had dates for real estate taxes paid before the date of the purchase, that means we can add it to cost as well. Sometimes we actually have like rent income as a part of our settlement. So that means that they pay us rental income for a month collected after the purchase date later. So we can include it in the rental income, but don't focus on that. This is just something for your information that can happen. And here we have all the settlement costs. So everything here in green is actually will be part of our cost right here. So you see like all this title, loan fee, appraisal fee, things like that. So let me show you how it works in Excel. So for example, here, our cost would be calculated this way. So it will be purchase price and it will be cost. And here I just listed all the costs one by one, 450, 495, all these things would be included. So the total closing cost is 13,953. So we add those two numbers and this is our total cost of the property. But it doesn't mean we can depreciate all of it. We can depreciate only building. Land we cannot depreciate. So this consists of land and building. So we need to find a ratio for us to separate land and building improvements. And the easiest way to do it is to find this. So I usually look for property tax bill. And property tax bill for a rental property has this breakdown. So it says land cost this amount. So this is our estimate and this is the best estimate we can use. And here's the one for improvements. So and I just divide them and get the percentage of land in improvements. And this would be, and divide our total investment cost by whatever percentages is. And this would be our cost for land that is not going to be depreciated. And here's the cost for building, 89%, right? Improvements. I mean, here it's improvements, but it's actually buildings and improvements. So this is cost of our building that will be depreciated. All right, hope that makes sense. Let's move on to next things. So also I forgot to mention when we deal with what is that? So this is our sale agreement. There are certain fees that cannot be included in cost, and those are things like fire insurance premiums, what else? Rent and other expenses that were paid to somebody, like to renters before the closure, for example, and any charges connected to refinancing and things like that before the closure. So those things are not included in cost, but they can be deducted later. Awesome. So we just looked how to separate land and building costs. And so this is something we'll include on our depreciation schedule. So we'll include land. This would be our cost. It will be no depreciation because land usually don't lose its value. It doesn't wears out as building does. So we don't depreciate land. We do depreciate buildings. So this will be our cost for building. The date that will put all these things under depreciation schedule would be the date when the rental real estate is ready for rental. So whenever it's ready for rental, that's a date placed in service for our building, land improvements, and things like that. Here I also go under IRS website to look up how many years we depreciated certain things for. So if you have any, so I'll just go quickly over things that can be related to our rental real estate. So that could be equipment. So we depreciate over 5 years. Furniture, we depreciate over 7 years. And residential rental property, we depreciate over, I'm just trying to see like where did we got here. So we depreciate over 27 and improvements, we depreciate over 27 and 5 years, 27 and a half. And 39 years, it's for residential rental property. Non-residential has 39 years. So if it's non-residential rental property, we depreciate over 39 years. And for residential, we depreciate over 27 and a half years. So I think that would be a basic to know about rental real estate and how to include it under depreciation schedule.